To what's happening in the BFSI space, and Cholamandalam Investment and Finance is on our radar. Remember, the RBI amended prudential norms on capital adequacy, which has given relief to the entire space. But before we speak with the management, Shivam joining in with the details.
Yes, the ECLGS scheme was launched in 2020 to support the MSME business and corporates which are mainly impacted by the COVID-19. And after that, the norms were including that the ECLGS loans operated will have a normal applicable risk weights assigned to the guaranteed portions. But now RBI has made amendments to these norms, and 75% of the guaranteed norms will be assigned with zero risk weight, and this will be applicable if the guarantee settlement is within 30 days of invocation. Also, the remaining exposure will follow the existing risk weight norms, and this will be effective since June 16. Now, what would be the impact of this? So, it is expected that the company will have lower capital requirement on ECLGS loans, and also there will be more lending capacity. In terms of factors to watch going forward, we have capital adequacy trends, utilization of ECLGS benefit, and also the MSME lending mix.
Got it. All right, thanks so much for that, Shivam. We've got Arul Selvan, who is Chief Financial Officer, Cholamandalam Investment and Finance, joining us. Mr. Selvan, thanks so much for taking the time. Help us understand this landscape, right? So ECLGS was a pretty large scheme that was announced by the government. It was meant as a measure to support the smaller borrowers and give them capital. With the reduction in this risk weight on 75% of the outstanding, how does that reduce your cost? Does it increase your lending?
The ECLGS scheme in form, this is version 5, is more applicable to working capital. And so actually benefits banks more than NBFCs. But there is a benefit to us on exposures which are working capital related, like trade advance for vehicle finance or MSME supply chain and other working capital related loans. Even in the unsecured side, what are the we are evaluating this, and to that extent, what is said is true, that there will be a reduction in the need for providing capital because 75% of such exposure will be treated at zero risk weights. So to that extent, we will have a lower capital requirement, but our capital adequacy is quite strong, and at this juncture, this is not going to make not going to be a very big advantage, but it will certainly add certain amount of flexibility to us in bringing capital, little later.
What is the kind of demand, Mr. Selvan, very good morning, Tamanna here, that you have seen for this scheme so far?
This is actually, this is for existing working capital exposures. If you read so it is not that, now we will add something new to it. Yes, as a routine basis, as we keep on moving with more exposures and how this scheme pans out, we will have to evaluate that.
No, so the context of my question, and allow me to explain, this was also because the idea of the scheme was to give some relief to SMEs, especially at a tough time. So I'm just trying to get a sense of the kind of appetite out there, and as a result of that, the stress in the system.
See, yes, what will happen is exposures to the working capital related lending, if they default, then there could be a recovery which is guaranteed by the government. So that to that extent, the exposure, we can increase the exposure for such lending to the customers who are needing such exposure. Now, that by itself will give us some comfort, but we have to still go through the same underwriting principles, because we need to look at it that in the long run, we have a same approach to our customers with regard to lending various, for various requirements of theirs.
Fair enough. My question is about the appetite on the customer side. Is there a fair bit of appetite in the system for topping up loans or that kind of an emergency credit line?
See, appetite from customer end is always there. What we need to do is to be be watchful or be wary about what sort of appetite, how do we satisfy them without hurting ourselves with credit losses. Appetite will always be there.
Okay. Mr. Selvan, good morning. Hiral here. To follow up on that, the question then is there a disbursement multiplier effect that you will see as well? And if so, by how much do you see it increasing? I know even a ballpark number is something that we should be watching out for, because aggressive credit is what you can probably look at.
Frankly, I wouldn't put that we will go overboard on our lending because the scheme is available. We need to see the longevity of the scheme and how far and how long it is. So we already are growing, are committed to grow at the same 20 to 23%. I think that is a fair amount of growth rate we are targeting. And as I said earlier, this pertains to a very small portion or part of our overall lending book. Most of our lending is for term loans like vehicle finance or loan against property, etc., which does not squarely fall into this scheme. So we may not be separately pushing up our needle on the disbursement and the AUM growth. Our AUM growth target remains at the band what we had earlier said, which is the 20 to 23%.
Okay. Mr. Selvan, the other question I have is in terms of where business goes. Last couple of sessions as well, we've seen a good uptick coming in terms of stock prices. I'm saying if you talk about CV lenders, if I talk about CV players. Now, to tie that up with business, what is that recovery looking like? Because after that stagnation that we saw in the CV demand in 2025, it seems the numbers are telling you that there is something substantial when you talk about the kind of auto sales numbers that are being reported. What is on-ground reality telling you? Because then if you tie that up with the monsoon deficit, what is the reality looking like?
See, the CV volume will pick up and has already picked up even in Q4 of the last financial year, and even in the first quarter, the first 2 months, we have seen good traction on the CV. So we expect that to continue because it had been going through a long, lower cycle in the last 3 years. So it is expected to grow and the cycle is expected to turn. Yes, the monsoon or the delayed monsoon could delay this process, but overall replacement demand is good and there should be a good traction in the pickup in the CV demand. We are seeing it already. It should further be increasing in the festival season, which is expected to be in the second half. The caveat only being a very severe monsoon impact that could delay this process.
That's a significant caveat, and we'll know soon enough, Mr. Selvan. On the cost side, you've already seen bond yields come off quite substantially, and ultimately that is something that you would watch very closely. What does that mean for the spreads that you might have perhaps in the second quarter? Because, essentially most of the first quarter is done. Do you anticipate that your cost of funds would reduce in the second quarter and therefore margins would be better in the second quarter than in the first?
Sorry to disappoint you, but I would rather say that the spike was very temporary and then the subsequent fall had brought it back to the same levels as it was, pre the spike, or I would say the Q4 levels. So we will expect it to continue at the similar levels of H2 levels in Q1, Q2. The cost of funds would remain at similar levels as H2 of the previous financial year, and if this monsoon continues, inflation does really move up, then there could be a possibility there is a bit of a cost hike in the cost of funds in the second half of this financial year. However, we are committed to hold the cost of funds more or less at similar levels for the full year as compared to previous year.
Not disappointed at all, Mr. Selvan. Thanks so much for answering my question. Appreciate it. Stock is active, by the way, so the market is listening while we're speaking to you. So thanks so much for taking the time. All right, we have to slip in over.